So these videos are going to launch us into Module 5, where we're going to talk about income statements and discontinued operations. There will be an additional module, Module 6, that will also deal with the income statement. It'll go into some additional issues, EPS, statement of comprehensive income, retained earnings issues. One thing I wanted just to call your attention to, and I will in class again, that now the problem sets will start to deal with not just one module, but two. So you'll just have a single problem set on the income statement that will cover both modules 5 and 6. Anyway, so let's talk about the income statement. What is its use to investors? The primary purpose of this statement is to examine, analyze the present and the future performance of a company's profitability. So it's both something that we want to know, well, how did the company do this quarter or at this year, but also so that we could extrapolate this information into the future and say, how will the company do in the future? How can we predict the company's future performance based on the information that we have here? It also helps us determine what's the risk or the uncertainty. Risk usually deals with how uncertain something is. If it's highly risky, it's highly uncertain, of achieving future cash flows. Remember that not only in an accrual system, accrual basis accounting, better predicts future cash flows than cash system accounting. So while we are developing a accrual measure of income, future cash flows, then cash system. So while we are developing a number that is based on accruals, net income is an accrual-based number. The revenues and the expenses that we're recognizing on this statement are the result of an accrual process. It still helps me determine future cash flows better than the statement of cash flows would, which is kind of ironic, but true. The formatting of this statement, just like the balance sheet is supposed to analyze risk. We order it in terms of liquidity. The ordering of the statement of income is helping us determine which of these items are going to be temporary versus persistent income components. So if they're temporary, they're just here for this period, and then they might not be there next period. If they're persistent, then we would expect them to recur, to come again and again, time after time in the future periods. So in that mindset, we order the income statement in terms of their expected persistence in future streams of income. The most persistent items are listed at the top of the statement. So the further down we go in terms of expenses and revenues that are presented on the income statement, the less persistent things become. And that's going to be so key in understanding the placement and the general geography, if you will, of different sections on the income statement. So let's talk about a few things that we could do to analyze the information we're given on an income statement. The first is the return on equity. So the return on equity is the amount of profit earned on investors' contributions to the firm, and return being the profit on equity being the contributions to the firm. So simply divide our profit or net income by the average shareholder's equity, providing the dollar of income generated by $1 shareholder's equity. Typically, we see this expressed as net income divided by common equity. So notice we're talking about common equity. We're not necessarily talking about all of shareholders' equity. Remember that shareholders' equity could have preferred stock. It also has items that are indirect investments. So, in this case, retained earnings or accumulated other comprehensive. Really, the focus is on the common shareholders. So any common stock and APIC common stock. Now that's the one that's most generally accepted There are others that would do total shareholders' equity or include indirect investments, but at that point, we're getting away from the direct contributions of shareholders. But others are used in practice. But this would be the most literal translation of that. Like I said, we could have net income divided by total shareholders' equity. That's probably the next most common. And from our discussion on the balance sheet, you really should know the difference between the two. You should understand what it's telling you, that this will include the preferred shareholdings, if there are any. It'll include any retained earnings. It'll also include any accumulated other comprehensive income, whereas this one is just talking about common stock and APIC common stock. Return on assets. It's very similar. Right now, of course, we're taking net income. We're seeing how net income is generated by the resources of the company. And I forgot to mention up here, we're taking average common equity and average total shareholders equity. And the reason that we're doing the averages of those items is because we have a item that's coming from the balance sheet. So in both of these, the denominators are coming from the balance sheet. Right, we're grabbing equity numbers. And the numerator is coming from, of course, the income statement. And so we have a bit of an issue in terms of we're dividing something that is over a period of time by something that is expressed as a point in time. And so we have a mismatch, right? So this is, for example, January 1st, or December 31st, but this is during the year that happens between them. And so the best way that we have to determine, okay, well, if we had this much income over a period of time, would be just to take an average of shareholders' equity or an average of common equity at the beginning and end of the year. I mean, that's a somewhat imprecise. I mean, the absolute best way would be to take a weighted average every day of what was common equity every single day over the 365 days, because net income was generated over a period of time. Then our average would be best at a period of time. Then the average would best express how that equity changed over that period in time. With return of the assets, it's the same thing, except that now we're dividing by another balance sheet item, not equity any longer, but by average total assets. And of course, there's not as many variations on this one as there is equity. Equity is a little bit more of an abstract concept. What are you really looking at? Are you just looking at the equity from common holders? Are you looking at a more comprehensive definition of equity? With this one, we have assets, and we want to see how the company is turning every dollar of assets into a profit. This actually is considered to be a little bit more telling, more relevant in determining true efficiency in profitability. And, why might that be? Why would assets, the dollar of income generated per asset, be a little more telling than the dollar generated per dollar of profit generated per dollar of equity? And the answer kind of lies in where we were previously, that if we think about how assets are generated in a balance sheet sense, right, they don't come from one or the other, but they come from a combination of these two roles of financing, liabilities and equity. So when we take average total assets, we're understanding how the company employs all of this in order to generate income, because L plus E equals A. So if we're figuring out for every dollar of A how much profit we generate, then we're determining how it takes all of the ways it finances its operations and turns them into profit. Whereas if we're using net income divided by total shareholders' equity, then we're just looking at a section of its financing and how that translates into profits. Or if we take something even more narrowly defined, common equity, we're taking just a section of this in a very relatively small section of equity, especially for companies that have been around for some time. We also have a times interest earned or interest coverage ratio. This one isn't so much of a profitability. I mean, it's related to profitability because we're on the income statement, but it's more of a solvency issue, because what we're looking at here is how do the earnings of the company, how many times do the earnings of a company cover the interest payments due to its debt holders. So we take earnings before interest and taxes. We basically take net income, add back interest expense, add back tax expense, and we get earnings before interest and taxes, and divide this by interest expense. And this gives us that idea that, if we have $100 of EBIT, earnings before interest and taxes, we only have $10 of interest expense, then I could cover that 10 times over 10 years by just 1 year of EBIT. I'm good for 10 years because this would also be expressed in annual terms, annual interest expense on the income statement. So some of the limitations of the income statement. One of the problems of the income statement is that it excludes items that cannot be verifiably measured or have no dollar value. So remember that this goes back to one of the topics we talked about in the very first module. This relates to the monetary unit assumption. That unless something has a quantifiable dollar value amount, that we cannot put it on one of our financial statements. So things like good employee morale, excellent CEO, knowledge or innovation, ability to change markets, all those things that are important for a leader of our company, that's not something we can really quantify into dollar value. Market niche, how a company has niched itself in the marketplace, its monopolistic ability to control a market that it operates in. Those things, again, don't have a quantifiable dollar value. They are indispensable to the company's operations, but they are not necessarily reflected in the book value of a company. Values are affected by the choice of accounting method used. So we have numerous choices in certain estimation techniques. One of the ones that you're most familiar with is just the calculation of depreciation. There are 3 or 4 different ways that are more common that we can use to calculate depreciation. And then related, but just more general, a lot of the values we put on here are based on judgments and estimates. So this is an effort of 2 characteristics kind of coming into conflicts. Judgments and estimates are used by accountants because they happen to be extremely relevant. They can make differences in our decision making. For example, when we have a bunch of credit sales outstanding, then we want to report an estimate of the credit sales from customers that we do not believe we are going to be able to collect. That's our bad debt expense. Now, that is an estimate that could be wrong, but it does feed our financial statement users relevant information. It could change what they think about the $1 million of accounts receivable the company has in its ledger balance, because if of that million, the company is not going to be able to collect $400,000, well, then that doesn't seem as impressive as if they have $1 million and the company says, hey, our estimate of bad debt is only $50,000, right? That changes how a user is going to evaluate the financial health of that company in terms of its accounts receivable portfolio. There's a lot of other estimates, just that's one that's you're probably most familiar with. But this is an example of relevance over verifiability. And remember, that's another characteristic of accounting information where we want things to be verifiable. That is, we want we want to take this to a series of experts. We want 9 out of 10 doctors to agree on this measurement of how we are expressing the value of our assets. We want a consensus, a lot of different opinions coming to the same outcome. But that's not always going to be the case, especially when we start getting into judgment and estimation procedures. The very last thing that I want to talk about here is how we define quality of earnings or earnings quality. So let's talk about earnings and just very, very primarily, if we talk about net income, if we talk about earnings, if we talk about profits, these are all synonyms. They can be used interchangeably. They all represent me taking revenues, subtracting off expenses, subtracting off adding gains, subtracting off losses, and coming up with how much is left over after all of that is assessed, right? So all of those terms can be used. I remember I had a little bit of confusion in my principles class, and I didn't want to sound silly and ask, well, are earnings and income the same thing? They are. If we have quality earnings, this refers to the ability of current earnings to predict future earnings. So that whole ability of the income statement, or the usefulness of the income statement, remember, it's not only to provide us a present glimpse of profitability, but also a future extrapolation of what profitability may be in the future. So if earnings have high quality, then it's the ability of current earnings to predict future earnings. We bolster this by organizing the income statement with an eye to how these flows are going to persist in the future. So remember, as I said, on an income statement, if this were my example of a very simple income statement, then the things I put at the top here would be more persistent, and then these guys down here would be less. And in fact, I would probably need to reorder. It's actually in somewhat of a proper order, because revenues and expenses are more likely to be, or are by definition, involved in the ongoing central operations of the company, whereas gains and losses result from incidental transactions that the company involves itself in. Now, investors, creditors, regulators, more so investors and creditors, want smooth earnings over time, rather than the realization of volatile spikes in profits and losses year over year. So what smooth earnings means is, if I have, and I'll draw just a small graph down here. So I got time and I've got net income expressed here. What we want to see is earnings that track with a gentle slope, right? So that if I'm here and this is year 1, then I know my year 2 earnings aren't too far off, and my year 3 earnings aren't too far off. I can project with some measure of success this very easy, accurate trend, versus if I had something that looked more volatile, like I have in this problem. If we have quarters of 24 down to 5 up to 20, then we're talking about something up here, something way down here, then something maybe back up here. And so that becomes extremely hard to predict, right? What's going to happen after this third realization? I don't know. It might dip back down again, or it might shoot up even further. We want to provide users the ability to map future earnings, because nothing can frustrate or upset a lot of the financial markets like having a volatile or unexpected realization of income.